So, good morning. My name is Leonardo Gambacurta. I'm the head of Innovation Digital Economy here at the BIS. It's a great pleasure to welcome you all to this session on data governance and competition policies. So, after the keynote by François Villeroy de Gallo comparing the adventure of big tech in finance to a formation novel, I think that the scope of this panel is just to add a little contribution to this to the plot of this novel. But the difficult task, as explained in the introductory remarks of François, and also yesterday in the speech by Agustin Castens, is that the entry of big tech into finance creates new trade-offs between efficiency and consumer protection. So on one side, we have definitely efficiency. This has been reminded also this morning in the speech by François, because building on the reinforcing nature of this data network activity feedback loop, the big tech can collect more data, they can serve more financial products. They can, in a way, also increase financial inclusion by serving unserved part of the population. And there is substantial evidence for this. Also, at the BIS, we have research conducted in this area that has shown that the data replaces collateral in reducing asymmetric information problem, and also that the use of QR code payments data allows the big tech to generate credit scoring and therefore to supply credit to small enterprise, and in this way also to reduce financial exclusion. But if on one side we have efficiency, on the other side we have challenges for consumer protection, and because this data network activity feedback loop creates situation of market dominance, the use of artificial intelligence can allow big tech to pre-discriminate in a very precise way each consumer. They can understand our demand schedule, they can extract all our consumer surplus. So this is very scary. And there is also an issue in terms of algorithmic discrimination. This machine learning could be trained on data that at the end could produce biases towards minorities. And of course, there is the one challenge is about privacy, because opening access to our personal data, we can, of course, lose our privacy. So there is the need to have a right balance between the use of new technology to increase efficiency and consumer protection. And we need to find this balance. But how to find this balance? So this is the question for the panel today. We have an excellent panel of speakers who do not require much introduction. We have Benoît Coiré, to my right here, is the president of the Autorité de la Concurrence in France. And nice to have you back here in Basel, Benoît. Sheldon Mills is executive director of the Financial Conduct Authority. I know the FCA is very active in the analysis of how big tech enter into finance and the opportunities and challenges that they raise. We have Limoges Merling Magazanik, who has experience both in government and the private sector, and now she's also entered the academia as visiting Duke University. And Luigi Zingales from University of Chicago Booth School of Business. It's easy to introduce Luigi, who is one of the most influential economists in the world, and on top, he has done a lot of work on financial development. It is very important for the discussion today. And Luigi is joining us remotely from the West Coast. So, hi, Luigi. Welcome here, even if virtually. So, I would like to ask each panelist to begin with a 6-minute introduction. starting in alphabetical order with Benoit Corré, who will help us to set the stage, and also giving your experience, Benoit, both as a central banker and now as head of the French Competition Authority. I think that you are very perfectly placed to start this discussion. So the floor is yours.
Thank you, Leonardo. Thank you for having me here. It's really nice to be back here in Basel at the BIS. I can see that the BIS remains the epicenter of thinking about these issues, as it should. So congratulations for all that. As you just said, Leonardo, I recently moved from being a central banker to being an antitrust enforcer, which comes with many challenges. I'm not going to. I could write a whole book of sociology about that. I once joked in a conference that my job had changed from dealing with Okun gaps to dealing with Harberger triangles, and no one laughed in the room at all, and I realized they were all lawyers, so that was the reason. So anyway. So I can see that people do laugh in this room, which is very heartwarming. So I think the core challenges of regulating big techs in finance have been very well described earlier in this conference, and including in the two very nice speeches by Agustin and by François. So I don't think there is a need to be very long on that. The way I would say it is really to sum it up with three different notions or mechanisms or dynamics. The first one, which is very simple, is that both the financial industry and the digital industry are about processing information, fundamentally, at a very fundamental level. So that makes the temptation and the incentive to combine data also to provide financial services irresistible, because that's in a way, at a very high level, this is the same line of business, and then it's being enforced in different ways. And certainly what we see now, particularly with in terms of technological developments, with all kind of predictive analytics and AI and machine learning and all that, makes it even more compelling to build. So it creates this incentive to in both industries to collect data, to hold data, and to ring-fence data, as we know, and build what Hume would call a walled garden around the data, or a moated castle, or in competition we say ecosystems, but that's exactly the same concept. And then keep it there. So that's the first thing. The second thing is that when you think about big techs and finance, you see different kinds of increasing returns to scale being combined. I mean, you have an increasing return to scale which is inherent to data hoarding, but you have also different increasing returns to scale coming in, and here liquidity comes in mind. The provision of financial services benefits from having access to more liquidity, and that's another increasing return to scale, which compounds with data access. So it's increasing returns to scale square in a way, and that makes it even more powerful. And third, so that's about the breadth of the increasing returns to scale, or the conglomerate effects, as we would say in competition, that can come. And then you have speed, building on existing networks, and that's very much what Facebook has tried to do with Libra. You build on an existing network to enter a new industry, so that you can leapfrog a customer acquisition and move directly to the next stage with an existing network, and that creates a lot of additional speed. And this combination of breadth and speed is that's what becomes a challenge for antitrust, because it's very different from what we've seen in earlier industries. So what are the risks? There are risks which comes from digital platforms generally, in financial services or any other activity, which are now well known through the practice of competition authorities. That's, as I said, leveraging existing comparative advantages. That's about attracting consumers and locking consumers in, which is a lot of what we do what we try to avoid as antitrust authorities. That's about restricting the access of rivals to the platform and to data. That's about self-preferencing when offering services on the platform, and that's about cross-subsidizing with sometimes also with an exclusionary purpose. When you apply this to financial services, there are of course differences across activities. So if you, for instance, you can think of a big tech using its marketplace to offer financial services as an intermediary, right? As you know, allowing lenders and borrowers to meet. And here, some of the risk I can see is to show some of the shortcoming of the originate to distribute model that we've seen in previous instances, like obviously in mortgage in mortgage lending, for instance, where there is no skin in the game for the platform, and there is a risk to push the risk to the lender or to the borrower, and to lose what is one core function of the financial industry, which is risk monitoring. And if big techs are themselves active in lending, of course, this comes with upsides, which Leonardo has mentioned, like, alleviating collateral constraints using data. And I mean, Leonardo's research has very nicely shown that it is there. It's important. But it also comes with other kinds of risks, such as a liquidity risk to existing intermediaries, like sucking liquidity out of the financial system, or trapping liquidity in closed ecosystems and losing what should be a core property of the global financial system, which is that liquidity can flow around. That's very important for central bankers. And that was one of the worries about Libra, that liquidity would be trapped in some liquidity pockets on some platforms and not flow anymore through the system. And there can be other risks, such as leaving only the high-risk customers to banks and capturing skimming the market and capturing the most profitable customers and so on. And then there are risks related to big tech being third-party service providers. That was, I think, mentioned in Agustin's speech and also in a whole session yesterday, led by Juan Carlos. That's particularly true for cloud services being provided by big tech to the financial industry. So what can we do about that? I think there is a big analytical challenge to understand what's going on and keep up with the pace of innovation. As competition authorities, we are not only fining firms or blocking mergers, we can also do studies. So, for instance, in my institution, the French Competition Authority, we issued a study, so a market study or industry-specific study, back in 2018 on online advertising, which helped us go much deeper into the understanding what's the two-sided markets in a platform, which can also be applied to financial services. We had a joint study with the German authority, the Bundeskartellamt, in 2019 on algorithms and how algorithms can create also collusion, implicit or explicit collusion between firms. We had a study in 2021 on the fintech industry, which is straight in the scope of what we're discussing today. And we are currently completing a study on cloud services, which will be released towards May, June. And so it's not specifically about the financial industry, but it's going into some detail into lock-in effects, obstacles to multi-clouding or multi-homing of cloud services, obstacle to mobility, to interoperability, and so on, and that can also be very relevant for financial institutions. So that will be out shortly. We can build on our existing practice in the financial industry, and there is a very long relationship between competition authorities and banks. We had a decision back in 2011 on credit cards, on the fee structure for credit and debit cards, which is a kind of a classic issue for competition authorities. We had a decision in 2010 on collusion between banks when digitalizing their services. And when you think about it, the very concept of a two-sided market, which I mean, from an academic standpoint, originates in the Rocher and Tirole paper of 2003, right? The payment market, of course, was featuring very prominently at the time in the discussion. And Jean, by the way, reminded us of this yesterday in his speech. So you can argue that two-sided markets existed before payments. Of course, the Marktplatz in Basel is a two-sided market, as we know. But still, I think the academic interest crystallized around payments, and we can still build on that. We can use our existing antitrust instruments. So maybe I can be more detailed later in the discussion, but antitrust has been criticized for being too slow and coming after the fact, coming after the battle. Which has been true in the past, but we are making an effort to be faster. We can combine different kinds of instruments. We can use interim measures, which allow us to act very fastly when we can show that there is an immediate damage to the economy. Of course, it has to be legally robust because it will be appealed. We've got to show our evidence to the appeal court and so on, but we've done it. Imposing interim measures on companies to make the practice stop immediately. That's something we can do, and we'll probably do more in the future. We can use, and that's, I think, an underestimated part of the discussion, we can use merger review as a way to avoid dominant positions to emerge. I think the best way to avoid abuse of dominance is to avoid dominance, to put it very simply. Sometimes it's too late, but sometimes it's still time. And I think the general trend in antitrust will be to be tougher on mergers to avoid dominance to emerge in some of these industries. And in Europe, we have a new legal twist which allows us to also to block mergers or to refer mergers, to defer mergers. Even below thresholds, so like a big platform buying a small company, we can defer it to the European Commission. That's called Article 22 of the merger regulation. That's for the fans, for the geeks, and we can use it to block a big platform buying a smaller company, and which would allow this platform to create lock-in effects or to lock in a technology. And exclude its competitors, and I'm pretty sure we'll do it more in the future. And finally, we can do. I think the defining question for us will be whether we should still be using antitrust instruments or whether we should move all the way to ex-ante regulation of some of these some of these practices. That's what the Digital Market Act in the EU does, with a limited number of practices for a limited number of participants. So it's not a Swiss knife that will allow us to do anything. It's for a limited number of platforms, and it's for a limited number of well-known practices, which everyone in this antitrust community agrees are bad, basically. And these have been kind of codified into the DMA, and it's now going to apply ex ante and to be self-enforceable. So these practices will be just forbidden. So there would be a lot to say about how antitrust enforcers will use all these instruments in cooperation with financial regulators and data protection authorities, but I leave that for the discussion.
Thank you very much. I mean, this is a very interesting introduction to the panel, and I'm particularly interested in this new ex-ante approach of the Digital Market Act. Maybe that we can follow up later with further information on this. But now I would like to pass to Sheldon to give us the view of the FCA on this topic.
Thank you. Well, I went the other direction. So I was a competition enforcer. I now don't sit in a central bank, but head up consumers and competition at the FCA. So no one laughs at my jokes in the FCA. Thank you very much for inviting me to this distinguished panel. I mean, we have issued a discussion paper in October last year on entry into retail financial services. And I'm sure we'll discuss later in the panel some of the regulatory powers that central banks or conduct authorities in financial services have around the world. But ours provides us with three statutory objectives. One is competition, one is consumer protection, and the other is market integrity. So this discussion paper sits at the heart of what we're always balancing. How do you balance consumer protection with competition? And then some of the wider points that you were making, Benoit, in terms of liquidity and the impact on markets of big tech entry. So the team are very excited because it's at the heart of our statutory objectives. The way we come at it is both to look at the competition effects of that entry, but also straight away think about the consumer protection risks which flow from that. And we do that because of those statutory objectives that we have. And we see that, and I'm sure you've discussed already, so I won't go into too much detail, but we see already that consumers are behaving in a completely different way to what they have. Each year consumers behave differently, and everything is on this device or on your laptop. From making payments to buying an insurance products to obtaining a loan, everything can be done through here. And it's not surprising, therefore, that given the different aptitudes and capabilities that big tech have, that they're very interested in financial services. They're very interested in the data. They're very interested in deploying their data to gain opportunities. And we've already started to see in the UK, and we're also seeing globally, some of the big tech's approaches into financial services. Take payments, for example. More consumers are opting to use Google or Apple Pay to pay for goods and services, certainly in the UK. And the tech firms are now well positioned to intermediate beyond that type of offering and just gradually capture more of that value chain. Now, that can facilitate greater competition. So my colleagues at, well, very complicated architecture in the UK, but my colleagues at the Payment Systems Regulator, which regulates payment systems, are very interested in tech, are very interested in the card schemes, as Benoit was mentioning. Can you totally disintermediate those card party schemes? So rather than having an interchange fee, almost qua regulation, can you think about how faster payments, how direct payments using new technology can work with those? And when I go and visit Visa or MasterCard, they often take me to their data bank and show me how they're working in a very different way to how they worked in the past, because they know the threat, the competitive threat that's coming from big tech and how data works. The other area that were very interesting is this concept of gatekeeping. So once you have a power or dominance over a particular input into products and services, so data or search engines or advertising, do those companies start to set the framework by which others interact with them, including financial services? So Google decides what ads or results it shows on its search engine. It also can ban, from a financial promotions perspective, in the UK we have rules on that, it can ban false and misleading financial promotions. So we proactively in the FCA have to work with Google in order to work out how we can apply our own legislation on financial promotions and misleading ads, which is quite fascinating. I mean, they're a gatekeeper for us and the work that we do in that space to protect consumers from misleading financial promotions. In addition, Apple and Google can set their App Store requirements in financial services. So, for instance, one of these firms has an internal policy about the interest rate that loans provided through their app can be at. It has a level. And actually, funnily enough, it's basically a cap. You cannot put your app and provide loans or offer loans unless your interest rate is below this level. Now, funnily enough, this level is at a rate which I would love to impose on the industry from a consumer protection perspective, but that's irrelevant in many senses. That's the sense of that gatekeeper role in action. That's the power of some of these firms, the practical power that you can see. We are worried and concerned that over the long term, these firms can easily exploit and entrench market power, which effectively can harm healthy competition. So there are lots of benefits that Leonardo has put forward, and we will look at those. But Benoit mentioned self-preferencing, there's tying, there's bundling, there's lots of monetization strategies. So the offers that you might get might be zero or low prices, but actually you're giving up your data, you're giving up more than what the price is there. So we're worried about these sort of issues. We're also very concerned to look at data more generally, not just for big tech, but also the way that financial services firms use data, either enhanced by working with big tech or for themselves, because our financial services firms hold a lot of data already about their customers, and integrating that with AI and machine learning, what happens in terms of price discrimination and other types of issues. There are many issues which have already come through. In the States, there's research around lending in certain jurisdictions where people of color effectively have been excluded from certain types of mortgage rates. And there's a lot of research in relation to that. Once you add data, multiple data to the equation, because those settings are quite easy, you know, people basically, all the black people lived in this community and all the others lived in that community. So actually you don't really need much data. You can, you know, it just flows naturally through the bias in the system. Whereas you can price discriminate in very different ways, not necessarily along lines of race, all sorts of ways if you have the data. And we have to work out as a society whether that's a journey on which we wish to go in. And financial services firms need to think about that. The other area, you know, in competition field, we often think about buyer power. It's another theme. So we are looking at big techs as buyers of financial services and what that means in the concept of how they face into the market and some of the acquisitions and joint ventures and tie-ups that they look at. So Amazon, which already has payments products, just announced a partnership, global agreement with Stripe, for example. So there are different ways in which big tech can interface. So what will we do? Well, we'll issue a feedback statement in the later half of this year. We've had a few round tables with big tech and other industries. And then we'll think about what we need to do. There are lots of options. We, unlike other regulators, have competition enforcement powers, so we can do cases in financial services. So all of the things that Benoit mentioned, we can do, and we may well do. But I also think that, and we'll discuss this in the panel, that we do need to engage with other types of regulators, so data protection regulators and other types of segments to work through whether or not holistically regulation can actually tackle the risks that we're seeing. We'll also look closely at what I call the perimeter challenge. So the big tech firms, I've discussed this openly with them, sort of trying to call them out on this, but they don't bite. They're quite well lawyered up. It's fun. But the big tech firms sit outside the perimeter, so their work often doesn't fall within a country's version of what activities are financial services. And I think there's a genuine need to discuss whether we expand that perimeter. So all of the investigations into cloud services, operational resilience, third parties, et cetera, that's all about, are we going to expand that perimeter because we think there's a major risk either to financial stability or firm viability or consumer protection. And I think we need to proactively think about expanding that perimeter. I think in advance of that, what we are doing at the FCA, and whether or not this is fair or not, we think we need to do this, is we are putting those obligations on the firms and the way in which they partner or work with big tech. So the firms which we regulate, effectively, these are your distribution chains. You need to monitor and manage them against these principles and these frameworks. And that's our approach at the moment, but I think there's a wider perimeter challenge that we need to discuss, and I'm sure we'll discuss. Thank you.
Oh, thank you very much, and these are a very interesting point. You put a lot of on the floor for further discussion. I'm very interested in this concept of the gatekeeper, the perimeter that you see as need to be enlarged, but also on one point that you mentioned that the big tech they give us apps and instruments that they seem free for us, but we don't realize that we inevitably pay these services just giving them our personal data. So Limor, I think that coming from experience from government, private sector, now academia, you can give us your view on principle on the personal data, how you see this trade-off between efficiency and consumer protection.
Thank you very much. So it's a pleasure being here. I'm going to say up front, I'm a lawyer, I guess in a room full of non-lawyers. So following up on that, I have a tall order. And I'm a data expert, and you've heard that data is very boring. I personally feel that data is super exciting. I've been working in the data governance protection space for the past 15 years. And in my defense, I will say that for 10 years, I was heading the enforcement department for the Israeli Privacy Protection Authority. So what I was doing was quite practical. And I'm going to try and share with you some principles, insight, experience from the past 15 years that I've been in this space. And I would like to highlight, firstly, coming from the data governance world into the financial sector world and the regulation of finances, firstly, to highlight a few, I think, major differences that will definitely affect the questions that you've already raised here since this morning. So firstly, financial regulators work in a space that is very well defined. You have a list, basically quite closed list of financial institutions that usually are licensed, and you know who you're dealing with, and the parameters are very defined. In data, you don't need a license to process data. You just go about doing your business, whatever it is you're doing, whether it's finances or commerce or healthcare or government services or whatever field you're in. You just go about doing your business and you're processing data. You're creating data, you're collecting data, you're processing data. And you need to comply with the general data protection regulation if you're in the EU. And we already have copies of the GDPR in many countries, Israel included and others, not necessarily same copies exactly, but we have similar structures, US excluded at the moment. But you have general data protection regulation, which means you have general rules of how do you need to conduct yourself when processing data. But you will not get a list of this is how you do data protection in the financial sector, in payments apps. There's no such thing. And you will not get necessarily a knock on door from a regulator on a regular basis. So you might get inspected at some point, but for the most part, most organizations, both companies, businesses, and government agencies don't necessarily meet a regulator for data protection for a very long time. So it's very different in concept. Now, looking at data protection agencies, I used to work for one of them, and I have colleagues still in many of them. They're not larger than financial regulators, but their business, their clientele is hundreds of millions of potential companies. So it's a very different type of how you go about doing regulation. If I want to highlight just a couple of principles of data, I would say that firstly, the use of data, the processing of data requires under most regulations to have a legal base. So you look at the GDPR or other laws and you look for the legal base, whether that is consent by the consumer when you have an interaction with them, whether that's legitimate interest that is becoming less and less accepted by European institutions, whether it's fulfilling a contract, or whether it's national laws. And what I have been seeing in the past 6 years in this space, both in the financial sector, but very much also in the healthcare center. And I see a lot of commonalities between these two sectors, and we can keep that maybe for later. But what I'm seeing is specific implementations of data protection regulation in those sectors. So those would be specific legislations that are addressed to the financial institutions or to payment apps or to CBDCs or to open banking initiatives where we're looking at a space where financial data is being addressed maybe differently, some sort of a disruption, fintechs, big tech, whomever we want to introduce or introduces themselves into this space. And then what we're seeing is financial regulations taking the lead. I'm seeing this in Israel a lot in the past 6 years, taking the lead and creating arrangements, regulatory arrangements by legislation that are sector-specific to address the specific issues of that sector. And that, for me, makes a lot of sense because you know your market, you know what you want to achieve. You don't want to achieve only data privacy. which is important and has its own rationales and bases, but you also want to maintain economic stability, and you have others, competition, consumer protection, other incentives, other interests, public interests that you want to promote in your sector, and you're familiar with your sector. So I find that this is a very good way to go about doing this, introducing the data protection principles, the core ones, but implementing them in your sector in a specific way that addresses it. And now another cool thing I find in creating new regulation this way is that you can both say what is allowed, you can also say what is not allowed, you can create oversight mechanisms, and you can create powers of enforcement within these new legislations. So you're bringing in a model that is giving a full package to address the needs of this specific sector. And it is my observation and thinking that data governance is such a huge ocean of use cases that, to me, I'm seeing us today as a society, as an economy, as a data society and economy, entering already the third evolution phase of data protection. This is generation 3.0 for data protection. At the beginning, we had the very basics, starting with the OECD privacy guidelines and the European directive of the mid-90s. That was the first stage. Second stage, GDPR, and what we're seeing today onwards. To me, third generation, data protection implemented in specific sectors. And so, for example, I'm going to give one example of a question that I think is a core question when you're looking at data issues and big techs. So big tech already have troves of data that they have collected. According to the basic principle of data protection, the use of data may only be to the purpose for which it was collected. That's the purpose limitation principle of data protection. So in principle, those companies are not allowed to use the data for other things, which were not in the initial disclosure, transparency, or legitimate basis for the collection of the data. But now, if they're entering this new space of financials and they want to do fraud detection, they want to do to facilitate identity management and transactions, can they do that based on historic data that they already have that was collected, for example, in order to give the service of a social network platform? Can they do that on the data collected while they were doing their ad work business? So that is a question that can be answered if we sit now and think about how we want this regulation to look like, and we put the answer there. A forward-looking question would be, so for example, it was mentioned here that big tech is very much interested in going to payment or in going to financial services because it will acquire a lot more data. Again, according to the principles of data protection, we can argue that this data may not necessarily be used for any whatever purpose they would like it to be used. So for example, one of the things that commercial institutions and these companies find really interesting is to close a loop between a consumer seeing an ad somewhere online, a consumer clicking on the ad, going to the side of a retailer, shoes, fashion, whatever, a consumer buying that product, knowing whether an ad ended up with a sale to a specific consumer requires sharing of information between several entities along the way. Would that be allowed or not? That is a huge incentive for big tech to go into financial services. Is that something that they would be able to do or not? Do we leave it up to them to decide and give the legal answer when they sit with their attorneys and go over the GDPR and decide whether they can legally do that or not? Or do we have regulators take a look, take the initiative, and tell them what they're supposed to be doing? So I think I will leave it here and invite you to maybe elaborate on this as well.
Thanks a lot. Sometimes when we use our apps, you know, the app producer send us messages. So are we allowed to use this data for you know, other reason and so on? And in the week to use this app for free, we tend to say yes, 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 yes. So I'm very interested in your approach about putting some limit in terms of at the sectorial level, and this can be done in a way to protect also the consumer for misuse of data. But let's now turn to Luigi, and Luigi, thanks a lot for joining us from. I think you are in the West Coast, right?
Yes.
So the timing is not perfect for you, but I'm very happy that you make it, and I also suffer sometimes of insomnia, but should be not at the level to take part in a panel in the night. But Luigi, I think that given your background and experience in the field, I am sure that you will give us some very useful insight on this trade-off between efficiency and data protection. So the floor is yours.
So first of all, thank you very much for inviting me. And so I want to start with a factor that probably most people know, that recently the US Department of Justice has brought a new case against Google for monopolization of the advertising market. Now, you might wonder what this has to do with finance. And my answer is a lot, because it shows us very clearly how in the presence of switching costs, two-sided markets can easily be monopolized. And it shows the power that data gives to big tech incumbents to actually monopolizing this market and really influencing dramatically the functioning of the market. And so I think is a very useful case to study. So let me try to summarize, because this is quite a complex case, but I want to summarize some of the lessons that I learned from this case. Now, before I do that, of course, I have to say up front that what I describe are the allegations stated in the Department of Justice and the state attorney's complaints against Google. They are supported by documents and emails, but they'll not be proven in court yet. So, first of all, the factor number one is the advertising market is the largest market in the world by number of contracts sold. There are 5 trillion contracts sold every year. In this market, Google plays the role of the broker for the sellers, which are the publisher, the broker for the buyers, which are the advertisers, and the auctioneer itself. And the funny thing is that a few years back at the Steeler conference in Chicago, a participant asked Al Vayan, all economists know that he's the chief economist of Google, how the company managed this conflict of interest. And Al said, oh, the answer is too detailed for the audience and even for me. In fact, it's not too detailed. It's maybe too shitty to reveal, but it's not too detailed. So Google controlled a significant share of the demand for advertising by making ads on Google search available only to advertisers who use a certain software called Google Ads. By doing so, Google is able to control 80% of the small advertisers' demand. Then they make access to this demand contingent on advertising using another software they have, which is DoubleClick for Publisher. And since it's very costly for publisher to use 2 different software to sell ads, not only does this move allow Google to control 90% of the supply, it also locks in 90% of the supply, making any alternative not viable. Because if 90% of the suppliers are locking into DoubleClick for publishers, then nobody else can get a scale large enough to attract a market. So the only threat to Google power could come from a large player like Facebook. So what did Google do to prevent this risk? Actually, they signed an agreement with the fancy name of Jedi Blue, in which offer Facebook several informational advantages to make sure that Facebook only use sort of the product of Google and doesn't go with any other competition. And ironically, one of these advantages was not to use Facebook's bid data in bidding against Facebook. So in this agreement, Google recognizes that it has a very valuable information derived from the data on the bid, and it offers not to use it against Facebook in exchange for securing this business. If this is not enough, both complaints allege the presence of price manipulation. Now, the funny thing, especially funny for somebody like Benoit, is that the project with which this manipulation was taking place is called Project Bernanke. So Google announced to the world that the ad exchange was running second price auctions, but in fact sometimes was paying the publishers the third price while charging the advertisers the second price and pocketing the difference. Now, with a pool of extra profits, was then rewarding the publishers who are giving Google information on the price of other exchange. In sum, Google was using the data and its legitimate dominant position in searches to monopolize the entire online market. So what are the problems here? The problem is a combination of three things: lack of interoperability, lack of transparency, and lack of data portability that not only the banking sector, but also in the social media sector. Everybody here talks about data privacy, but to some extent for an economist, data are meant to be used because it's a non-rival good. And a lot of people can use the same amount of data. So you want to, in some sense, facilitate other users, unless they are perverse, not restrict them, provided that you don't give an unfair advantage to the incumbent. That's what data portability is all about. And while I think we can think about interoperability by introducing not just a common API, but a standard API that everybody uses the same format, and data portability can resolve some of the issue of data. I think that for transparency are not enough just rules. We need an agency to enforce it. Because in the shadow, Google can do all sorts of shady things without anybody noticing, basically. And it took the DOJ, the state attorneys, to do major investigation to actually bring that to the surface. I would be curious to know from Benoit, what did the French competition authority identify studying the ad market without having access to many of the data that the US authority was forcing Google to disgorge? So I think that concluding, the risk of opening up the financial world to big tech without a proper rule in place is that what happened in the ad market will happen also in the financial markets with very serious consequences.
Thanks, Luigi. And I really appreciate your verve. It's incredible as usual. And well, as a chair, now it's inevitable for me to raise a question to Benoit to react to to Luigi's introductory remarks. Because I think that you're also interested in this aspect in your position.
No, I mean, sure. I mean, I think Luigi's description was very telling. And again, as Luigi said, that's the incrimination brought by the DOJ. And so we'll see what the US courts will have to say about that. We've been looking into related issues in France. We had a decision last year related to not to Google but to Meta, but also in the ad market, and the case against Meta that Meta was had initially been sharing data, I mean selling data to intermediaries that themselves were supporting companies to do their advertising programs, and then at some point Meta had started to exclude these firms, these intermediates from the market, and re-internalize all the ad business. And so here the bottom line was an agreement by Meta to commit to a negotiation framework with these companies and to reintegrate these companies into the business. So so that was not about breaking up Meta. That was about it was getting closer to regulation in a way, because we agreed on this commitment framework, which made, and that's actually the first time I think ever Meta committed to that kind of framework with an antitrust authority ever globally. But of course, now it remains to be seen whether Meta will enforce it, will apply it, and if they don't, we may have to come back to the more repressive approach and fine them and etc. So that also makes the case that there are different possible techniques to address that kind of situations. We had a related case against Google, but that was not ads. That was about the publishing rights, that is the remuneration of articles posted by Google, which Google had decided not to, well, Google had decided that the price would be zero. That is, that newspapers wouldn't be remunerated at all for for articles posted on the search engine, against EU regulation and French law. And that's an instance where antitrust could be relatively fast, because the French law was voted in 2019. With an obligation to remunerate articles posted on the search engine. Google decided that they would remunerate, but the price would be zero. Okay, so that was a very peculiar way to enforce the law. 1 year later, in 2020, the competition authority issued interim measures to force Google to negotiate. Still 1 year later, in 2021, we found that Google had negotiated, but not in good faith. Basically, the negotiation was a joke. And Google was fined 500 million euros, which is, I mean, it's small compared to the turnover of Google, but it's still sizable in terms of antitrust fines, €500 million. And last year, June last year, Google agreed on a remuneration framework for the publishers. And we were the first, together with Australia, to have that kind of a framework for publishers' right on search engines. So it's all in all, it's 3 years. You might argue it's still too long, but I can tell you that in the usual, compared to the usual time scale of competition law, it's very, very fast, 3 years. And then the DMA will come in, right? So the hope is that the DMA will help address some of these practices, including some of the practices which have been described by Luigi upfront. And I can, if you allow me, Leonardo, I can give very, very few examples of how the DMA would apply to that kind of situations in Europe. The DMA could help reduce the data advantage of big techs. So, for instance, a big tech company will not be allowed to combine data obtained through its core platform services with user data obtained from other services, say payment services, unless the end user has explicitly consented to it. Also, the business users will have access to the data generated by their activities, which today is usually not the case. That's about the way they accumulate data. But the DMA can also help support competition on a platform and also competition between platforms. So intra-platform competition and inter-platform competition, so to speak. On a platform, for instance, I'm just giving examples, but a gatekeeper will be banned from ranking its own products or services in a more favorable way than the services of third parties. So, for instance, in the context of payment services, this would prevent, say, the App Store, Apple's App Store, or the Play Store on Google, to manipulating the ranking of their own payment services, Apple Pay or Google Pay, against third-party payment services. That will be explicitly banned under European law. And also there will be the gatekeepers will be refrained from obliging end users or business customers to use specific identification services or web browsers or payment services, etc. And then in terms of competition between platforms, there will be a ban on preventing business customers from offering their products and services on third-party platforms. So on exclusivity, if you want. That will be explicitly banned under the DMA. So gatekeepers cannot enter into agreements forcing banks and financial intermediaries to offer their products through the gatekeeper platform. and not on the other ones. So that's examples of how that's not going to solve everything, obviously, but I think it's an important step forward, and it's going to be combined with other pieces of regulation, which I'm not going to discuss here. But we have in the background we have GDPR, of course, this has been mentioned, and we also have the Data Act, which is still being negotiated, but which will impose, it's in a kind of more specific way, but it will impose a principle, for instance, of interoperability on some services, and a principle of functional equivalence for some platforms, for instance, when the user wants to migrate from one platform to another. So it will lower the switching cost in economic terms. So that's slowly moving in the right direction, but there remains a big challenge which has been identified by, two challenges. First challenge, which has been identified by Luigi, which is how do we know what's going on? You can have great legislation, but if you don't know what's going on the platform, you're not going to enforce it. And in that Google case I mentioned, part of the discussion was about how do we access information inside Google, inside the platform, on, how many articles are being posted, how long do the users stay on the article, how many clicks away, and so on and so forth. So that's information that is very difficult to access. So we can do it as an authority. So I'm answering here to Luigi. We can use our legal powers. So we can go on site and ask for the data and ask for the laptops and so on. So we do that. But of course, we're not a regulator, so we don't do that on an ongoing basis. We don't have teams on site on Google's premises, so it has to be in a kind of very focused way. And the other challenge I would see is really the perimeter challenge. That is, even these new pieces of legislation will be applied, broadly speaking, activity by activity. So there will be a definition in the DMA of core platform services, but if you take Amazon, like cloud services will be a core platform service, and the merchant or the marketplace will be another core platform service. And so all these pieces of legislation, in a way, fail to capture all the bundling and tying and leveraging that happens across markets. Because what we are seeing now is multi-sided markets, which is complicated enough, and then you have layers of different multi-sided markets which are being tied together through bundling, through tying, and through leveraging. And what will remain the big difficulty would be to capture all these interactions.
Thanks a lot. I think that this new element of ex-ante regulation in competition is quite a change. It seems to me a change in gear in the velocity one could react to increase competition, and because of the competition authorities are typically accused to be, to arrive ex post, not to solve problems. So I think this is a very good approach.
If I may, since there are many economists in the room, that will raise. There is a whole research program coming with it. And the first question, which was in a way raised by Jean Tirole yesterday in his speech, is what's the best way to extract information on the costs that you don't observe? Like the switching cost or the opportunity cost of not being on a platform, that's unobservable. So what's the best regulatory mode, the best regulatory technique to extract that kind of information? That's an incredibly important question for us. Is it better extracted ex ante or ex post? I don't know. And maybe we can learn from telecom regulation and energy regulation or banking regulation, which are all ex ante regulations. Maybe we could learn more from that. And the second one is maybe more for political scientists, but I know the economists also have something to say about that. That's also about the governance. What's the most robust mode of regulation, in particular in case against regulatory capture? And we know that ex ante regulation can be captured, because when you see these guys every day, you have lunch with these guys, you go to their premises, and so on. So at some point, you can end up being captured. Well, when you do ex post regulation, you're like a judge. So you put a fine, and then you walk away, and then you don't have to talk to them. I'm kind of it might be a little bit sketchy as a description of what we do, but I think there are interesting kind of incentive issues around it.
Sheldon, do you want to add to this?
Yeah,
maybe?
just a brief point on this. I think the DMA is extremely helpful because it actually allows antitrust authorities to start the journey, and it may be them or it may be someone else, to get towards a form of ex-ante regulation through competition principles and economic principles. I think it's the right step because you can't turn a competition agency into an ex-ante regulator overnight. I mean, it'd be very difficult. But all of the outcomes that we've seen through the party credit card payment schemes and those cases there against MasterCard, that was effectively price capping of the interchange fee. But I think it took almost a decade to get to it because the institutions did not want to impose something which they were not used to doing. So it took a long time internally in the Commission and in other regulators to eventually say, we're going to have to put in place something that we wouldn't normally do because we want that market to work freely, but it's not working. There's a market failure here. And they've been tooling up for quite some time to do that. I think the other important point is that governance point. So coming from a competition regulator into a financial services regulator, at first I was horrified by what I thought was just regulatory capture. I mean, I was absolutely horrified that people would go into conversations with senior leaders and not actually have a series of questions and have got data before they went into the meeting. I was horrified. I kept that to myself for quite some time. I'm no longer as concerned, thankfully. Otherwise, I should do something else. Otherwise, I should do. I'm not. So you're definitely captured. I'm not. No, I'm not. I tell you why I'm not concerned. Because I think what's happening is that financial regulators are also realizing the power of data and information to do their activity, and the importance of objectivity, transparency, and skilling up to have those tools so that they inform those conversations. And I think the other point that I think we need in big tech firms, what's the obligation and responsibility of these firms with such power to society or to other business or to who they contract with? Financial services firms has an enormous amount of obligations on them. Leaders of those firms know those obligations. They know where the bright lines are. They know when they're skirting around, and that's why they come and converse with you. Big tech firms, to me, don't seem yet to have a set of principles, even amongst themselves on a voluntary basis, or imposed upon them by government or regulators. And I think that's needed because you can't always be in that building. You can't always observe that data. So something has to come internally to start those checks and balances. When I work with Google or Apple, it's incredible how, Luigi may know better than me on this, but it's incredible how disaggregated the power structures are once you get into the firm. So the decision trees, it's quite interesting. The governance model in terms of how they take decisions. And that obviously means that they can cause harm quite easily and quite quickly without any internal constraints. And I think those internal constraints need to come through somehow. So I'd be interested in the DMA. In the UK, we have the Digital Markets Unit, which will sit in the Competition Markets Authority. Will those acts and will the agencies which are pushing them through start to think about the internal principles within those tech firms and start to have those conversations with them?
Thanks. So, Limor, a lot of challenges here. Huh?
Yes.
So, given your legal perspective, I see challenges as enforcement, perimeter challenges, the regulatory entrapment. So, what is your reaction to these challenges? How can we cope with them?
I think I'm going to start, if I may, by maybe following up on a couple of,
Yes,
of
please.
the remarks prior, and then go into the regulatory challenge. I really have to say something about consent from the perspective of a data protection professional. And I applaud the EU data regulation package, and I include 5 pieces of legislation in that, which is the GDPR we already have in place, and the DMA, and the DSA, and the Data Act that is newer, and the AI Act that is expected to be finalized by the end of 23. And not just because everyone's talking about AI and it's fashionable, but because it has a lot to do with both the financial sector as well as other sector and how this is going to influence disruption, innovation in the financial sector, and the fact that AI models are based on data. And so much of the benefits and risks of AI in financial services have to do with the data that underlies it. So these 5 pieces of legislation have a lot to do with the future of data in the financial markets and big tech there. And consent. So it's been so well established, documented, and shown that consent is not a very good mechanism to rely on when we are processing people's data and still want to safeguard their rights and the rights of us as a society. So many funny and not funny exercises. People have consented to sell their firstborn son to whomever app was making them sign that. I agree, I accept, I agree, I accept. I started in privacy 15 years ago. This was already discussed back then and shown by many academic researchers. I accept is not an answer. Consent is a very weak legal base. So it is good when you're doing biomedical research, clinical research. You have 100 patients in front of you, you speak with them, you explain to them what's going to happen, what are the risks, what are the benefits, why they should sign. They read everything is read to them, and they sign, and that may be a good consent for using data in a clinical research. Scaling this up on an international, national, digital economy and society, I think it collapses. It absolutely collapses. So the DMA on the one hand is great. On the other hand, putting in there, unless consumers consent, then now the companies will just continue to do the same thing. Give us this block, we will consent, agree, accept, and we have no idea what's going to happen with the data. We have no actual control, understanding, or a say in what happens. So I'm very, very worried about consent in that mechanism. It kind of makes everything collapse. The second thing I wanted to talk is about regulators. So again, the package, the DMA and the rest are excellent, but each of them invoke a new institution of regulations. So there's a new institution to enforce the DMA, and a new one for the AI Act, and a new one for the DA, and a new one for the DSA. And being an ex-regulator, I was always conscious, I still am conscious of the fact that when an entity has so many regulators that it needs to answer to, that creates potentially chaos or conflicts. Or each regulator is now focusing on another entity that has no additional regulators. So for example, as a data protection regulator, having the entire market in front of me, and I know that the banking sector has their dedicated regulator that visits them all the time and is sitting on them, and the insurance have the regulator, and the health ministry is taking care of the HMOs. So I would think, okay, I'm gonna go to the old folks' homes, I'm gonna go to vulnerable populations, I'm gonna go to supermarkets, I'm gonna go to places where there's no regulations, there's a regulatory vacuum. But now when you have so many regulators out there, the second thing is the raison d'etre of each regulator is very specific to that regulation, to that potential market, to the powers of enforcement given to them in that regulation. And what they see when they wake up in the morning is that specific topic. Not necessarily all the other underlying complexities of combining competition and data and financial stability and consumer protection and innovation and inclusivity. So adding more regulatory bodies to the mix, I think it's good because we're giving more budget and resources for regulation. So overall, it's a good thing. But when we separated it into silos of different types of regulation, I think that is also potentially a misfortune that we need to be cognizant of. Last comment that I think is just from experience. The first thing that when I entered the Israeli Privacy Protection Authority, we were just building it up. One of the main things we had as a goal is to recruit people for inspection, especially, and for forensics that have technological backgrounds as well as a professional knowledge in either economics, law, whatever profession you need. We established a forensics lab so we would be able to take one of the, I don't have a phone, to take a computer, to take a phone, to take some sort of gadget, take it apart, and try and understand what's happening in there. So the lack of knowledge into what's happening in technology is a huge barrier for regulators. I think that today, every regulator has to have some sort, at least one or two people that have the technological ability to understand technology better, because when you're basing your regulatory decisions, when you're doing your investigations, you need an evidence base that is so highly technological. You need such high skills and understanding of technology that without that, you're very much an underdog with your constituency. So I'd say that getting people who have that knowledge should be a priority for every regulator in any space. Thank you.
But don't tell me, my kids, they always tell me I am a dinosaur. Luigi, you have initiated this discussion speaking about this case against Google. You made my life very easy. Do you want to have to close the loop and say some additional word? I know that you have also some ideas about the creation of an agency to supervise and use or the misuse of data. I don't know if you want to add something.
No, I would like to stress the importance that Europe is playing in regulation, because in the United States, the US government is basically owned by Google. So last year, there was a majority in principle to pass some reforms, but the bill never reached the floor because they didn't want to pass any regulation. So I think that the only chance is that Europe, through the regulation, will force the big tech to adjust. And because there are a lot of switching costs, they might use the switching costs in the right direction, because once you have a system in place, then you tend to use it everywhere. And it makes it easier for other countries to copy the EU regulation and to become the standard in the world. Now, with this, I'm not saying that the EU regulation is perfect by any stretch of the imagination, but I think that we really need the big countries without big tech. So mostly the European bloc and India, and now a little bit Brazil, to create an international constituency to push some form of regulation. And this issue of having an agency that ideally would be international, both because the problem is international, because the cost to monitor is very large, and because each individual country agency probably would be more easily captured, especially the American ones. So you want an agency to monitor what's going on inside this big organization, because by the time we see the problem, is very hard to undo it, or it's too late to intervene. And so I think that that's really what I hope is the future, a big push for international regulation. And in that sense, the BIS is an interesting model, because it's a model of international regulation of financial institution. I think we need a BIS also for the big tech.